Exhibit 4.20, a rally that began at area capital A hesitated for a few sessions in late March near $43.50, with some long upper shadows and a doji. With a push over this 5-day resistance area, the Japanese would say the dirt was blown away. The rally resumed in earnest until it was short-circuited at the bearish engulfing pattern on April 13th and 14th. Note the extreme size of the black real body of that pattern. This underscored how the bears had wrested control of the market from the bulls. This bearish engulfing pattern was confirmed as resistance a few weeks later with the emergence of another bearish engulfing pattern. This echoed the fact that each time the bulls were able to propel the stock toward $51.50, they couldn't hold control of the market. Let's look at these two bearish engulfing patterns and compare them to a Western outside reversal session. In a Western outside reversal session, I'll focus on a top outside reversal session. The market makes a new high for the move and then closes the next day under the previous day's close. The first bearish engulfing pattern, if in bar chart form, would also be a traditional Western outside reversal day, since the stock made a new high for the move with the top of the black candle session and then closed under the prior day's close. Now let's look at the second bearish engulfing pattern in late April. Note how the second candle in that bearish engulfing pattern failed to obtain a new high. Its high was $51 and the prior session's high was $51.75. Consequently, if this was a traditional bar chart, it would not have been a reversal signal via an outside reversal session, since it didn't make a new high. But with a candle chart, all that is needed for the bearish engulfing pattern is for a black real body to wrap around a white real body, which is what happened in this instance. This is a good example of how candles will provide a timing advantage on those who just use traditional bar chart analysis. In Exhibit 4.21, a bearish engulfing pattern in early July took the force out of the preceding rally. This bearish engulfing pattern became resistance for the next week and a half. Once Cisco closed over the highs of this bearish engulfing pattern on July 15, it was a bullish breakout. Even though it was a doji, the fact that it was a new high close is a positive. For those who are momentum players, the break above a bearish engulfing pattern could be viewed as an indication of a new up leg and a time to consider buying. To confirm a breakout, I recommend waiting for a close over that resistance area, not just an intraday break. Another bearish engulfing pattern was completed on July 21, became resistance that was tested in late August. Notice as prices approached the bearish engulfing pattern resistance area, a group of small real bodies reflected hesitation.